when ETH was ripping and Tom Lee announced his 20 billion at the market facility, and, that was late summer, right? That was a crazy time, very euphoric. Like, I would argue that was a banana zone, right? And I had to step back and be like, wow, I feel really good. People around me feel really good. People on Twitter feel really good. Like, that's just a time to be taking some profits.
If you'd have looked at that liquidity chart, would have told you the same thing, which is liquidity wasn't going up fast enough for the market to accelerate. And the reason being is it was exactly then in July when the M2 chart decoupled, all of these charts decoupled. And we're looking at this thinking, what the fuck is going on? And we realized for us, the explanation is it was the TGA rebuild. Suddenly they started ramping up the rebuilding of the TGA, which was withdrawing liquidity, and there was no reverse repo left to drain. So suddenly it was a big event. And then we had the government shutdown.
The crypto market is leaving even seasoned analysts uncertain this cycle. Price action is slow, liquidity signals are unclear, correlations are breaking down, and many are questioning whether the real momentum has already passed. That uncertainty is reflected in a recent discussion between Raoul and Burniske, who hold opposing views on where we are in the cycle. Raoul still believes this is a long, macro-driven cycle that could peak in 2026, driven by a yet-to-arrive liquidity wave. However, even he admits the usual signals aren't lining up, and the market feels unusually messy. When a traditionally bullish liquidity analyst begins to doubt timing, it highlights how unusual this phase truly is. Burniske, meanwhile, argues the cycle may have already peaked in 2024 during the ETF frenzy and major asset rallies. If he's right, the market isn't gearing up for another big run but entering a prolonged cooldown. This raises a tough but important question. What if the banana zone is already behind us?
In kind of the simplest framework, and this is the 4-year cycle framework, then Bitcoin is in the process of topping if you follow that 4-year framework, right? And then you would expect a bottom about 12 months from now. And you could say that that's due to halvings, which I think it's more dubious as Bitcoin's inflation rate diminishes. And you really think about the crux of the halving argument and, the amount of coins that goes to miners and proof of work and the cost to produce Bitcoin and all that. So there's the halving argument. There's the liquidity argument, which you've done a great job of educating people on, and Bitcoin kind of aligning with 4-year business cycles, and then the liquidity cycle on top of the business cycle. This is where it gets tricky, right? Because right now Bitcoin is deviating a bit from the liquidity cycle, right? And so I think we have to acknowledge, for me, that is a point of paranoia, right? Where I'm like, hey, the liquidity cycle would suggest that Bitcoin should at some point here do very well. Right now it's struggling a bit, but I can't ever get too confident in that view because I know that I could get my face ripped off if I'm not allocated enough to the upside and, liquidity dynamics kick in. But I would say kind of for me, overarchingly, the reason I started to, sound some caution, let's say, after really the 10-10 crash was the market was just feeling heavy to me. And there was someone who put a comment on crypto Twitter of, one way in which I look at markets is kind of as an organism. And I'm not as, kind of like focused on some pinpoints, and I'm not as deeply trained, for example, as you are on some of the detailed nuances of markets, right? And so then what I'll try and do sometimes is just step back and look at the organism as a whole and take in all those variables and say, okay, what is the mix of these variables suggesting? And so for me, we started to feel weird when, really Solana was not getting that much of a bid from its DATs and then anticipation of its ETFs, right? So you kind of had, you had Sailor and the Bitcoin DAT bid, which then went into the Ethereum DAT bid. You also had the Bitcoin ETFs and the Ethereum ETFs. Those two, those events were phenomenal for Bitcoin and ETH. You would have then expected the similar events to also be phenomenal for Sol, which, for me has been kind of the high risk asset of choice this cycle, right? And you've focused on Sui, I focused on Sol, pretty similar.
I had Solana earlier on and then did the switch, but yeah, completely.
Right. But like just thinking of a high performance L1, great, core engineering, interesting ecosystem. And so then when Sol was heavy through the DAT anticipation and then the pipes getting announced and kind of the announcements of those vehicles, and then heavy with the ETFs, that started to feel very weird to me, right? It's like, well, there's not a bid here and there's clearly a lot of selling if Sol's not rallying. And then that 10-10 liquidation, I mean, the only thing similar that I've seen was March of 2020, the COVID crash, and you had assets, like I looked at the portfolio, that day and, assets were down 60 to 90% on the day at a point in time. It was insane. And so what I didn't like about that was, okay, this cycle, there's been a lot of angst around, really in the long tail, right? Where's the bid in the long tail? What's the fundamental value in the long tail? How do you value these things? I would say things that we have anticipated for a long time, right? Like the professionalism of valuing crypto assets, and you and I have both, been early to trying to figure that out. Well, it's coming now, right? And so the long tail's not getting a bid. There's an AI bubble, and then the 10-10 crash revealed for a lot of assets where an organic bid materialized. And my paranoia in those wicks is, do we have to go back to those wicks, right? And some of those wicks suggest, bear market levels of where, especially in the long tail. I try and go with, hey, this time isn't different until there's a strong enough reason for it to be different, right? And we see that play out in all kinds of ways, right? And the reason things are never different is because human nature never changes, right? And you and I know that well. There are a lot of reasons for this time to be different though, right? Like there's, sweeping, legislative action and regulatory clarity in the US. There's major, traditional finance and traditional tech embracing of stablecoins and blockchain technology. There's ETFs in the market for the majors for the first time. Liquidity is coming our way. So there's a lot to suggest that, we could turn a corner here. And I'm prepared for what it's worth. Like BTC right now is 98. ETH is just above 3K. Sol's 140. I'm prepared for things to turn around from here. It's possible.
Yeah, because remember 2021 was a wild one for that. I mean, BTC went down 50% and then straight back up. I mean, that was not easy.
Yeah, and so like here, you're looking at BTC down 20% from its highs. ETH already down about 40% from its highs. And depends on which high you want to use for Sol, but from the December 24 high, Sol is down about 50%, right? I could see that being enough of a washout. I could see that if we rally from here, I could see that being very painful for a lot of people. If we step back with this cycle as a whole, right? Most assets bottomed December-ish of 22, right? And then 23 kind of wobbly until October of 23. From October 23 to the end of Q4, we ripped. And that was alt season for most coins. End of Q1 24, after the Bitcoin ETF gets approved, Bitcoin's, doing well. Everything's doing well. Everyone's hopeful. Everyone's like, oh my God, this is all going to happen again exactly as it happened last time. That was the peak. End of Q1 of 24.
Burniske sees this cycle as one that peaked early and became unbalanced, with the market now struggling to find real demand outside Bitcoin and Ethereum. He points to weak reactions to catalysts, crashes in smaller assets, and fading ETF returns as signs that the cycle's momentum may already be fading. For traders experiencing choppy, stop-and-go price action, his view helps explain why the market feels constantly heavy. Powell, however, believes the weakness is simply part of a delayed macro cycle. In his view, the real liquidity surge driven by refinancing, fiscal stimulus, and global easing won't arrive until 2025 or 2026. Markets feel messy because they're still early, not late, and without that liquidity wave, he argues the true bull market hasn't even started yet.
So my framework, the kind of One of my big lessons learned is every time I override a kind of macro framework with emotion is when I've kind of got it wrong really badly. 2009 was my worst year because of that. And so I've got this very robust framework called the Everything Code. Again, probabilistic, because I tell you, well, you say seriously, there's many other outcomes that can happen. But I got to this weird thing where I started realizing that the ISM, the business cycle, was a perfect 4-year cycle until recently. I'm like, what the hell is going on here? What's gone wrong with this cycle? And the work that I'd done was this was all a 4-year debt maturity cycle. And because of 2008, we had a debt jubilee and everybody forgave interest payments for 4 or 5 years. And what they did was restructure their debts. So this 3 to 5 years cycle, and we got this perfect cycle. This is the Bitcoin halving cycle. This is the whole thing. And then suddenly it stopped. And I'm like, interesting, because I calculated this 4-year debt cycle. I think I was the person who discovered it. So I went back and recalculated. And what I found was in 2021 and 2, because rates went back down to 0, they pushed it out another year. So it got to about 5.4 years. So I'm like, okay. So then when I put it back on a little sine wave, you're like, oh, that sort of makes sense. So we're still in the trough of the cycle, and we should be coming up with the business cycle growing because we've not had it grow. And then out of that, I've obviously been using liquidity as the main driver of all of this to finance the debt. So here's the interest payments that come due, and here is the liquidity to match it. And this is total liquidity in the US. So that's the Fed net liquidity plus banks and M2. And so that's where the money has to come from to finance the debts. Okay, so it makes sense. And then when you look at it, how I use it is financial conditions, which for us is the dollar, rates and commodities, leads total liquidity by 6 months, which leads ISM by 6 months or 3 months. So you've got this 9-month lead of financial conditions, which suggests that liquidity should pick up and the business cycle picks up. So that's the framework we've been using, and it's very good. So I'm like, okay, this is interesting. It's persistent over time. So we know that the ISM, so liquidity is the main thing. The ISM is the driver of the economy, and financial conditions give us the lead. When we detrend Bitcoin and put it against ISM, it's the same thing. So what it's telling us is Bitcoin is subdued because of the business cycle. And the reason the business cycle is subdued right now is because it's not the debt rollover year this year. It's next year. It's the next 12 months. So it's like, oh, okay. So the debt rollover year is the thing that makes the difference. And then you look at the correlation between, this is global liquidity. So we're assuming all countries do it. It's pretty closely correlated. And we've seen global liquidity picked up and it's pulling back down. And that gives us an R squared of 90% and 97.5% versus the NASDAQ. So it's like it's the most dominant macro factor in history, driven by the debt refinancing cycle. And the business cycle is a component of it. The business cycle has been lackluster for a number of reasons. And then when I look at this is US total liquidity against the crypto total market cap X Bitcoin. And basically it's the same thing. Now, recently we hooked lower because of this lack of liquidity. And this has been slightly overvalued. And every time we've got there, we've kind of caught up. And so the bet to me is, if I extrapolate all of this away, the question is liquidity going to have to rise because of this or not? Because if it is, the correlation of liquidity is so high that I would be ignoring the biggest macro factor we've ever been given and nothing would work. And then I go, the other way I think about this is, okay, well, the business cycle, if Scott Bessent talks all day about we need to get Main Street to have money and we've got a stimulus coming in terms of fiscal and we need to get, Main Street catching up with where Wall Street's been, that tells me the business cycle needs to go up. Earnings need to go up. Corporate earnings, household earnings, and not just the Mag 7. So if they want to win the next election or the midterms, this is the game to goose. And what's interesting is Scott Bessent's a macro guy. So that's what's in my head. And I find it hard to walk away from all of that. But I also see that the structure's not great and the markets are sloppy and all of the things that you say.
Well, it's your own paranoia, right? We basically
Right.
have opposite.
That's why I wanted to talk to you. That's why I wanted to talk to you, because I wanted to hear. I want to hear the paranoia, because I can confirm my view to myself all day.
Yeah, of course.
But I need to hear the whispering voice in my head to say, no, Raoul, you're a moron. That's the most important voice.
It wouldn't surprise me if you're right, but you're just a little early, and it's the debt refinancing year is 2026, right? And
well, it is. That's the point. So it's kind of, I can't see how we get a bear market unless all liquidity leaks into an AI bubble or something else.
Both analysts are reading the same market but drawing opposite conclusions. Burniske believes the cycle likely peaked early, pointing to ETF front-running, liquidation events, weakening long-tail assets, and fading buyer strength as signs the market has already shown its hand. Powell, however, argues the opposite through a macro lens. If global liquidity is the true engine of bull markets and that liquidity wave has not fully arrived yet, then the real peak must still be ahead, potentially not until 2026. One sees an early ending, the other sees a delayed beginning. The truth may lie in understanding both forces at once. Structural weakness and heavy price action are clearly present, yet a global easing cycle, massive debt refinancing, and new institutional rails like stablecoins, tokenization, and ETFs are also forming beneath the surface. You don't have to pick a side today, but you do need to understand the tug-of-war shaping this cycle. Do you believe the banana zone is still ahead, or did we already pass it without realizing? Are you preparing for accumulation or bracing for a longer cooldown? Share your thoughts in the comments. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.